Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at TRGP, or Targa Resources Corp. TRGP is an energy infrastructure company and provider of integrated midstream services in North America. Here is the barchart.com technical opinion rating for TRGP. The bar chart rating is a 72% sell, with a strongest short-term outlook on maintaining the current direction. According to Prime Trade Select rules, a stock is in a bear trend on a monthly basis if the most recent monthly close is below the 10-period or 10-month simple moving average. The monthly chart shows that TRGP was below the moving average line as of the April 30th close, so the monthly trend in TRGP is down. Now we're going to look at the daily chart. The stock is in a bear trend on a daily basis if the 50-period or 50-day exponential moving average is below the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line just crossed below the green line, so the daily trend in TRGP is now down. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy puts if the stock price is below the lower Keltner channel line. Anywhere inside the Keltner channel or even above the Keltner channel is fine. TRGP is above the lower Keltner channel line, so TRGP is inside the sell zone. Since the trend is down, we want to buy a put. TRGP has 9 option chains to choose from. We're going to use the July 18 option chain. Right now, the July 18 options have 74 days to expiration. Here's part of the TRGP option chain for, it's July 18, not December 20. TRGP closed at 161.87 on Friday. That means any puts on the list from 200 to 165 are in the money. Let's take a look at the profit potential for purchasing the 160 strike put, which is the closest strike to the current price of the stock. The bid-ask spread for the 160 put is 9.30 to 10. We tried to enter at the midpoint, so we'll use 9.65 as the buy price. Our put option calculator shows the profit potential for this put based on, based on TRGP price changes at option expiration from flat to a 12.5% decrease in price. We can see that if the TRGP stock price is flat at 161.87 at option expiration, the 160 put will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move down 1% for the put option we purchase to break even and start profiting. Sorry, the wording down under the rule is wrong. I'll correct that for next week. Now let's still combine a 180 strike put to see if it qualifies for the 1% rule. Here's the put option calculator picture of the 180 put. According to the 1% rule, we want the put to at least break even if the stock price is down 1%. The calculator picture shows that if the TRGP stock price is down 1%, the 180 put will lose 8.1% of its value. We want that to be break even or better, so the 180 put does not meet our requirements. Let's see if the 200 put will work. The bid-ask spread for the 200 put is 37 to 39.60. We try to enter at the midpoint, so we'll use 38.30 as the buy price. The 200 put works. If the TRG stock price is down 1%, the 200 put will make a 1.8% or $145 profit. That's better than break even, so the 200 put is the one we'll buy. The put option purchase calculator also shows that if the TRGP stock price decreases by 2.5%, the 200 put will make a 10.1% or $388 profit. If the TRGP stock price decreases by 5%, the 200 put will make a 20.7% or $792 profit. If the TRGP stock price decreases by 7.5%, the 200 put will make a 31.3% or $1,197 profit. The minus 10% and minus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the TRGP stock price does not make the expected move down and remains flat at expiration, the 200 put would only lose minus 0.4% or minus $17 compared to the minus 100% or minus $965 loss for the 160 strike put that we looked at earlier. Now we want to review a put option debit spread, aka a vertical put spread. For this spread, we want to buy to open the TRGP July 18 185 strike put and sell to open the TRGP July 18 175 strike put. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 185 put for $25.35 and sell the 175 put for $18.20. $25.35 minus $18.20 equals $7.15. So the entry price or debit cost for the spread is $715. The put option spread analysis calculator picture shows that the spread will make a 39.9% or $285 profit if the TRGP stock price increases by 7.5%, remains flat, or decreases in price when the options expire. Creating the debit spread will allow us to collect an $1,820 cash credit to our brokerage account for the sale of the 175 strike put. As we said on the previous slide, this reduces the cost of entering the spread to $715. Here's a note regarding earnings reports. The next TRGP earnings report is scheduled for July 31. Let's review the trades one more time. The first trade was a put purchase, said to buy to open the TRGP July 18 200 strike put for $38.30. We also reviewed a spread. Spread said to buy to open the TRGP July 18 185 strike put and sell to open the TRGP July 18 175 strike put at a debit of $715. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.